Hi, everybody, and welcome to the final Fatel Daily podcast video of the week. It's the second week of Jan that we've been back, and I wanted to ask you a question. You know that moment in basketball when a player makes an elaborate head fake, or maybe even in boxing as well. I know that's what I do, and everyone falls for it. Well, according to my guest, Nick Hubble, right now, we might all be falling for something similar in the financial markets. Now, while the world is convinced that we're entering an era of sustained high inflation, Nick, you've spotted something that suggests this might be one massive head fake. So what the hell are you talking about? Let me know.
Yeah, it sounds so controversial now that everyone believes in high inflation, but I'm sure when you'll remember that back when we first started working together, the big story was that nobody was able to generate the inflation that they wanted. For decades in the case of Japan, for many years in the US, and a little bit longer in Europe, central banks have been trying all sorts of weird, wonderful techniques to try and push up inflation rates, to try and keep them up above or around 2%. They were stubbornly refusing to move. So we've gone from sort of one extreme to the other, right? And this is causing huge chaos in financial markets. The bond market sell-off recently are hitting stocks as well. And then when the inflation fear reverses a little, it really pumps up financial markets. So this is the big topic at play, because if we're in for an inflation cycle of higher inflation over a long period of time, that's going to absolutely hammer people's investment returns, apart from all sorts of other things like pushing them into higher tax brackets. My worry is that we are basing our assumption of higher long-term inflation on the exception that proves the rule being that we remain in a low inflation environment for various different reasons, such as demographics and debt deflations and government debt levels. So I'm worried that what happened in 2022 and 2021 has been misunderstood. And what was a once-off shock to the system, which will not repeat, especially not over long periods of time in the future, has been, has sort of made everyone think that we're in this new environment. And the reason I say that is that what happened in 2021 was a spike in the velocity of money. So if you imagine an economy with $10 in it and one widget to buy, the price of the widget's $10. But if the amount of purchases that are being made doubles, it feels like there's $20 in the economy. So the price of the widget goes up to 20. So the speed with which money circulates in the economy, the velocity of money, has as much of an impact on inflation as the amount of money in an economy. And what happened in 2021 is that we had the lockdowns because of COVID. First of all, I should talk about 2020. So we had the lockdowns because of COVID, and all central bankers knew intuitively that means the velocity of money was going to crash. The speed with which money circulates, with which money is spent in the economy, was going to crash because nobody's allowed to go outside anymore and spend their money. And so what they did in order to offset the effect of falling velocity of money is they printed lots of money. They created lots of money. So you had an increase in the supply of money, which
What a surprise, that's the solution.
Yeah, right, it offset the falling velocity, and you got a fairly stable inflationary scenario and economy despite the lockdowns of 2020. But they didn't undo that increase in the money supply when the velocity of money came bouncing back in 2022 and 2021, the second half of 2021. So when lockdowns ended and suddenly everyone could, you might remember the whole revenge spending story. All of a sudden people were spending loads of money, including what they'd saved up during the pandemic. So the velocity of money bounced back to where it was before, but all of a sudden the supply of money that had increased so dramatically remained there. The point being that the inflation of 2022 and 2021, and to some extent 2023, was caused by this inflationary V shape. Was caused by this V-shaped velocity of money. It's ironic because they're both V.
Yeah.
The plunging velocity of money during the lockdowns and the recovery of the velocity of money. And by the way, the recovery in the velocity of money in the US corresponds quite well to the rate of inflation, adding a further bit of evidence to this. And my point is that we're not going into pandemic lockdowns repeatedly for the next 10 years. There's no obvious reason why the velocity of money would suddenly surge again as it did in 2022 and 2021. So anyone who's predicting a sustained period of inflation for the next few years needs to explain to me where the inflation is going to come from, given that in the period before 2021, all of the possible reasons for inflation to emerge applied and happened. So central banks printed lots of money, government debt was very high, we had sovereign debt crisis, we had the demographic shift. All of the reasons why you might want to expect inflation applied before 2021, but inflation didn't emerge. And the only time it did was because of velocity of money shock, which is completely unique. And my point is that I think people are assuming that something changed in 2021, 2022. Perhaps it did, but perhaps it didn't.
Mm. Can you elaborate on the specific market signals that make you suspect that we might be falling for a feint or as you say, a head fake, rather than a genuine secular shift in this area?
Yeah, there's an interesting story about how bond yields increased over the last few weeks and months, almost globally. In some places, they actually broke out in the UK and the US, for example. But also in Australia, we had a spike in bond yields. But all of the possible reasons for this have arguments against them that are very convincing, actually. So, for example, inflation expectations haven't actually suddenly moved higher. They've sort of sustained at quite a high level. So the bond market move hasn't been inflation based. We've had a bunch of other explanations that the borrowing rates of governments. So if governments borrow more, they probably need to offer more yield. That might be true, but not all governments around the world experiencing this bond yield surge, suddenly have more plans to borrow money. In fact, some have plans to do less. So the only plausible explanation I can find for what's going on in bond markets is that the uncertainty around inflation has gone up. And markets don't like uncertainty, so they price in a higher return, which means higher bond yields, which means falling bond prices in the case of bonds. So what's happening is investors are saying, well, inflation might be 5% or it might be 0% over the next 20 or 30 years. I'm no longer sure that it's going to be 2.5% or 3% like I thought a month ago. So the possible ways that history might unfold here has widened, which adds evidence to my theory that people are starting to wonder, and we'll soon discover that perhaps inflation actually will go back to how it was before the pandemic shock made us think that inflation is back. And another good example, actually, of some evidence for falling inflation, apart from the inflation statistics that were released quite recently from several different places around the world, which came in below expectations, we also continue to have central bankers saying they're going to continue to cut interest rates because they expect inflation to fall. So there are some signs here that people are waking up, especially over the last few days, and especially since I wrote this article and submitted it, that people are realizing that perhaps the inflation story is not as simple as it seems. Perhaps inflation is not back. There's an additional point I really want to make, actually. My argument here is that central banks and governments are going to try to cause inflation over the next decade and a half, or perhaps 2 decades. They need inflation in order to bring their government debt back under control.
Debt, I was going to say, yeah.
Yeah, this applies less in Australia, but increasingly so. So my prediction, actually from 2020, was that we're going to enter a high inflationary period. What I'm saying here is that they're going to fail. What I'm saying is that they might want inflation. They might print money to cause inflation. They might have excessively low interest rates to cause inflation. They might do all of these things to try and cause inflation, to try and deal with the government debt loads. But I think they're going to fail because that's what they did for decades before 2021, when the COVID inflationary shock came along. It's what the Japanese did for decades, and they just were not able to produce the inflation that they ever wanted. So I think that the point is I'm yet unconvinced that any sort of inflation future is actually going to play out.
So just so I understand it right, the reason why you think it was so bad, inflation spiked so much in the last few years, is purely because of that ultra rare event that shut the economy down, which led to a huge increase in the velocity of money. But you're just not seeing where that is going to come from again.
It's the reopening. It's the reopening of the economy after the lockdowns. So the reversal of lockdowns. And to be clear, if central banks hadn't printed vast amounts of money to try and offset the falling velocity during the lockdowns, then a recovery in the velocity of money would just kept everything overall stable. It was the failure to remove the money that they pumped in that gave the velocity its added shock. The equation is MV equals PY, meaning the money supply times its velocity is equal to P, which is prices or inflation, times the real economy. So the only way for the inflationary shock to happen is either the money supply or the speed with which money circulates has to increase.
So,
In the first half of the pandemic, the velocity of money fell and the money supply increased. In the second half, the money supply stayed stable while the velocity suddenly recovered, which means it jumped about 20%, which is about the inflation we got.
yeah, I think Jim Rickards was pretty much on those same lines. But just for real layman's, right? Because a lot of that is a little bit theoretical, right? So I'm an investor looking ahead to 2025. What metrics or what should I be watching for to differentiate between what a temporary spike or and a genuine structural inflation?
Yeah, it's a loaded question, Woody, because my point is that everyone's wrong, that
Yeah,
markets are
well,
wrong. So I can't tell you what people should look for. I mean, I can tell you what people should look for in the sense that what
buy
happens when
gold.
people discover that inflation is not going to be sustained at a very high, let alone a high level, and its bond market moves. So if bonds rally back to very low yields from today's 4.5 in Australia, just over 5 in the UK and US, if interest rates fall, bond yields fall, bond prices rise, inflation expectations fall back down, that's the sort of market move we'd expect. It should be good for stocks, in just like we've seen in the last few days, right, where inflation came in unexpectedly low, and we saw the effects of the stock market and on the bond market. Stocks rallied, gold rallied, central bank interest rates are likely to be cut. So it's sort of vaguely good news because inflation is usually
Good for stocks.
it's usually bad news.
Yeah. All right. So you suggest that, like, final question. You suggest the potential repricing in, like you just said, in both bond and stock markets if inflation declines. How does this scenario play out differently from the negative yield environment that we saw in pre-2021?
Yeah, the negative yield environment's tough because that was pretty darn extreme. It just doesn't make any sense, historically speaking, in any sort of financial or economic terms. But that is the sort of thing that I expect us to return to: extremely low inflation, extremely low interest rates, extremely low bond yields, pretty much just what Japan experienced. So if you look at the last few decades of history in Japan, apart from the recent stock market rally over the last year or two, that we're going to be returning to that very familiar time period and environment where central banks and governments are trying to engineer inflation, not getting any, and instead blowing asset bubbles, like the housing bubble, like the tech bubble, stock market bubble, that bond bubble with the negative interest rates. So it's sort of a back to normality, back to a continuation of what had been happening in the years before. What's important about this is that currently bond yields are very good, so it would make sense to invest in bonds at, say, 4.5% per annum yield on the Aussie government bond, because that's a good return if inflation rates really are going to be coming in below 2%, say 1%, over the next few years as inflation moderates. I think people need to be wary of assuming that a multi-decade trend has changed because of something like a pandemic coming along, right? Because after the pandemic ends, the economic conditions that preceded it will come back. And so you'd expect that the economic, the investment environment will come back too.
Yeah. All right, fascinating stuff, Nick. We'll leave it there. For those watching, if you'd like to see what this discussion is based on, the link to Nick's full article on our website is below. Do check it out. It's 100% free as always. Let us know what you think in the comments. Thank you for your time, Nick. We'll see you again next week.
Good to see you.